Welcome. Today we are going to discuss about financial literacy for early professionals. Since you have been into your first job, obviously you will be getting your salary on the last working day of the month. And I feel that it is very important for you how to manage your finance, and for that what is the literacy you would require so that you can manage your finance better. And today what we are going to discuss is something related to that, but at the same time this is not just for mastering the financial literacy. It is a basic, or to start with, what is required for you. And each one in the topic we are going to discuss today is a ocean by itself. So you need to understand that the whole banking financials industry, BFSI otherwise is called, and that domain runs on this. So you need to understand whatever that is required for you at this stage. And from that perspective, we are going to discuss about the financial literacy for early professionals. And financial literacy is a crucial foundation for your security, your independence, the way you handle yourself. So, and we are going to cover from that perspective. This presentation is going to cover your salary management, the budgeting, savings, investment, debt management, and a few more topics. First, let's understand what is income, or what are the types of incomes. You have income is what you get, for example, as part of your salary, that is your income, or any money you are generating is an income. The gross income means that earnings before any deductions. We will see what the deductions are or mean. Net income is the one which you take home. You call it as take home salary, right? So take home pay. So take home pay is after taxes and deductions. So you need to understand what are the tax brackets. So here you will have central or federal, state taxes, state taxes, and your any other local taxes like your corporations, etc., or anything you are contributing for any security and stuff like that. And obviously you will know that taxation is from the government in your respective country, and there are different types of taxations, different types of rules with respect to each country, and the way the deductions are handled, the way deductions are computed in the tax calculations also vary based on your country. And the general objective of everybody, including me and all of you, is that we will try to minimize the taxes you pay or I pay, so that you will maximize your income. So what are the ways by which you can do is what we will be discussing in a while. And because you are working in an organization, your employer might also contribute some finance for you. And there are for example, retirement plans. In case of India, it is like pension funds, family pensions, like that. Or if you are in the US or any other country, you may have like something like 401k kind of a thing. There are some insurances which will help you from an employer perspective, so health insurance and those related benefits. So the objective here is that you need to take advantage of these benefits in such a way that of course your income will also be calculated and the taxes will also be minimized. And the fundamental point here is that because you are an employee or you're going to work in an organization, the whole thing begins from your salary. So how you handle your salary is what the matter. So there are some rules. The government rules are there. Our corporation or company rules are there, and with that, they will try to box you in certain salary brackets, which will attract certain kinds of taxes and deductions. So from that perspective, at the time of negotiation itself, you must be very clear about how much you would get it as gross income, or how much you would get it as net income. Probably you can ask for a kind of simulation of salary slips, and of course there are a lot of components within your salary, like certain things are monthly, certain things are quarterly, certain things are yearly kind of a benefit. So you need to be very clear what are the taxable components and how what component can cover or where you can save, okay, by applying to certain benefits or schemes. So salary fixation is the beginning of the whole thing. So once you have your salary on hand, whatever is the net, okay, assume you got some X amount at the end of the month, you need to have a kind of budget, personal budget, of course, personal budget, that how you manage. So there are 2-3 models. I'm going to tell you about 3 models here. First model is 50-30-20 rule. Second one is the forced saving approach. This is my view. And the third one is zero-based budgeting. These 3 we are going to discuss slightly in detail in a while. So with these budgeting models, what you should plan is that how to track your expenses, because once you are on a spree spending, you need to know that where your money is going. So from that perspective, you need to manage or track expenses. Obviously, there is a saying that you cannot control what you cannot measure. So you need to measure or track your expenses or your spending habits. And there are some tools like Mint, YNAB and other popular tools to track budgeting tools, and which you can try as well. Now let's get into the details of this budgeting rule 50-30-20. What is this 50-30-20 rule? A simple budgeting method that divides your income into 3 categories. The first category, which is 50%, is 50% of your needs need to be met. So all your essential expenses that are necessary for your daily life, such as rent, mortgage or utilities or any other expenses like groceries, households, your gas, or any repayments, all these things will come into this 50% need, because without which you cannot manage your day-to-day operations. So the next one is 30, which is your wants. So what these wants are, these are non-essential stuff or enjoyable expenses. Probably that includes dining out or entertainment, some hobbies, like you may be very good in photography or recreational activities. You may go for clubs, shopping, for example, it could be clothes or gadgets, or it could be streaming devices or subscriptions. Maybe you go out for travel and leisure as well. So these are all the things which are wants. Then the 20%, the third one, the 20% is for savings and debt repayment. Here the focus will be on financial security, like you want to invest or reduce your debts. So and you will also have plans for emergency fund. You need to keep it aside. So that is one. Second thing is with respect to retirements. probably you will invest in stocks or some kind of mutual funds. Then there is a debt payments which you have to handle for your EMIs. So how do you manage that? So why you use this 50-30-20 rule? First, it is very simple. So there's a structure is simple, so you can categorize need, wants like that. Second thing is it is flexible based on your income. You put into 50%, then you will know what is your money, etc. And you can set a goal for managing these expenses, or in any of these 50-30-20, you can set a goal that you don't go beyond that, or you want to reduce further down and revise the goal. So this helps so that you can lead a better life, not just for the day but for the future as well. The next one is zero-based budgeting. Okay, so here the zero-based budgeting means but it is just a budgeting method, okay, in that sense, where every money, every dollar or every rupee, every cent of your income is assigned for a specific purpose, ensuring that income minus expenses equals to zero, which means that you know that for every money you receive, you will correspondingly map your expenses or what you do with that money. That is what the zero-based expenses mean. So here how it works, you calculate your monthly income in case, or if you are getting it, so get your monthly income, total all the sources of income for the month. For example, if you are just a salary employee, then it is just a salaried amount, and if you have got other sources, then take all the income into account, include all categories like your utilities, rent, groceries, or your entertainment expenses, your emergency expenses, and all that you get into one list. Then assign each one, every money you spend, every money you receive, you map that to each category. Okay, so I receive 100 rupees or $100, so where this is going. Same way, vice versa, for entertainment you will map from which money you will get it. So this way, if you are a corporate, for example, I know this is a source mapping, fund source mapping. The same way in your personal budgeting, for every expenses you need to have the corresponding source mapped, which is your salary or what part of the salary you are going to map. Somebody may even have something like this. Suppose your typical structure is basic income, there is a HRA kind of a thing, house rent allowance, then there are some various categories of benefits you are entitled to, or you may get it as a money. Then you have got so many expense mapping, right? So you will have, as we said, rental, you will have entertainment, you will have groceries, utilities, like that. So you should, for an effective planning, you should have a mapping of, okay, I will use 50% of HRA for my rent. I will use the remaining 50% of HRA for my insurance. Like that, for every expense head, every income should be mapped. When I say expenses, this is not just expenses, that includes any saving or investment. So every thing, every income should go to map to everything which you do out. Okay. So here what happens is that you can control every dollar or every rupee which you are getting it out, so that you will know that where you are spending your money. So this gives you a kind of flexibility, and you can also better plan your savings. For example, I'll just give you some simple example. Your monthly income is say $10,000 or 10,000 rupees, and you are spending for your needs, say 5,000 rupees or $5,000 for your rent, groceries. So the remaining one for all your wants, like dining out, entertainment, stuff like that, and whatever is the remaining one is the amount you are going to save, or you are going to use it for debt repayment. So this total should match with your income total. So that is how, so the income minus your expenses or any payouts, basically it's a payout, right? So any income minus payout is zero. So that means every money which you have received is accounted for. The next model is forced saving model. Okay, in this case, I would suggest that whatever is your income, take 40% out of this entire game. Okay, that is for savings. How you save, where will you save, that's a different question that we will talk later. But you take, suppose you are going to get say $1,000 or 1,000 rupees in a month, so you will take 40% of that, which is say 400 out. So in the remaining 600, you split it like this: 30% for your basic needs like your house, utilities, commute, food, in any interest payment, etc. So just 30%. Now the remaining is again 30%. Out of that 30%, take 10 for contingency. Like you may have to buy something, or you are planning for something, some contingency plan you are having, or maybe for health benefits, something like that. The second 10 is for investments, exclusively for investments. This you can have it for a long-term investment, or whatever way you want to call is an investment. It can be on stock, it can be on mutual fund, it can be on gold, it can be on real estate, or it can be on anything. Okay, or it can be on a banking deposits. Maybe you the remaining 10% you assign it for entertainment or relationships or something like that. So all the money in the interest in the interest payment, right? We discussed that 30% is going for interest payment, right? Whatever is the money you are going to spend for interest payment, make sure that the main purpose of getting that value is mapped back to improving your savings in the future. That is the essential part here. For example, you are trying to buy a bike. Okay, so what you do for the bike, if you think that your bike you are going to use only for going out or for a movie, then it may not add value to your 40% saving. On the other hand, if you are trying to use that bike to go to office, wherein your purpose is to earn more, right? So which means that the more you earn, the 40% of your earning from 10,000 to maybe 12,000, so there is a jump of 2,000. So the purpose of the utility should always try to improve the value of your income or your income itself, or anything directly or indirectly. Indirectly can be in terms of knowledge, or in terms of anything else, or the utilities for that knowledge, where that is indirect. Whereas if it is direct, means okay, I go and work for more hours, so I generate more income. That is direct. So anything which you are going to spend, okay, here this is where the next bottleneck comes. How do we get that? How do we get into that much of money? So we need to go for loans. Just hold on for a second. We will finish the third one, and then we will come to this. The whole thing, what you need to understand is that how the whole thing is going to work in a compounded way, because $1 or 1 rupee you are going to get will remain, or it will be less than that value over a period of 1 year. So based on inflation, based on so many other factors. So then what is the way by which you generate more money out of the money you have? That is what we are going to discuss for a while now, which is basically a compound interest. So what is compound interest? It's an interest calculated on the initial principal and also on the accumulated interest from the previous periods. That is also treated or deemed to be a principal. So allows investments to grow faster than a simple interest or a normal interest, where interest is only earned on the principal. So there are some formulas, there are some methods by which compound interest is calculated. So you can go to website and see what is the compounding effects are. So once you know this compounding effect, so For example, over a period of time or a longer with a period of investment, the compounding has got an exponential growth, and is better. Why we are discussing today? Better that you as a early stage career professional, if you start investing sensibly, prudently, then the compounding effect will have as we said, it is going to have an exponential impact, and that exponential growth is going to come to you at a early stage. So that's a powerful mechanism which is happening throughout the world in all the countries in terms of how the compounding works. So here the point is how you save the money is very, very important. We said discuss about in the forced method we got 40% as savings. So savings means this is taken out for either it can be on a bank deposit. So you need to understand what are the ways or how it is structured. Generally, when you go to market, there are two types. One is the organized sector and another one is the unorganized sector. The organized sector is something like bank or any stock market. Those things, anything which is regulated by government is all government sector. Whereas on the other hand, anything which is not regulated by government, which will come under organized sector. So that way, where you got money, right? For 40% of your savings and 10% on investment in that order, which we said. So that money, so is nearly 50% of your income. So where do you save this? Where do you put this money? So now there are multiple options. Okay, if it is in terms of direct financials, yeah, it's again organized, unorganized sector like banks, etc. Whereas if you are going slightly non-financials, like for example gold, silver, or real estates, like you may want to buy a plot or a flat, whatever, or a house. So those things are non-financial assets. So you need to understand how these things work. That is a separate topic by itself, and we are not going to discuss that in that much detail now. So you need to assign. If you put down all these headings and the money, whatever is your money, you need to against the heading like house. So this is the money I am going to invest. This is the gold. This is the bank deposits. This is mutual fund. This is stock market. This is currency exchange. And so that there are so many financial and non-financial avenues for investments. So you put, and the one golden rule is that never put all the money in the same bucket. Okay, suppose you want to buy gold, and you got 1,000 rupees or $1,000, don't buy gold for all 1,000. You split it. There are scientific methods by which you can split it. Like you can put some 20% on stock market, 20% on mutual funds, 20% on gold, 20% on that. So there are multiple ways by which you can do, and that again depends on your A, risk appetite, and B, when you need the money back, or when you would be expecting that money to be utilized by you in future. So the investment is a separate topic, but you can put it down in a spreadsheet and try to map your income. And I've been asked to give some demo of how to work with some calculations, etc. I've been requested by quite many viewers and friends. I'll take it as a separate exercise and in another video. But for now, this is just a example. So once this investment part, everything is over, you need to plan for your emergency. So you need to understand what is your safety net for unexpected events. If you are really, probably the probability of getting into some problem is very less. But if you are older, obviously you need to plan for emergency funds. And what is the amount of money you need to plan? That is the next question. And how long you need to manage that. Okay, so when you are putting an emergency fund, it could be for any major expenses like or illness or any events like marriages, or it could be in case that you are going to be out of job. So you need probably 3 to 6 months of your monthly income as a potential emergency fund. So you need to plan for that, and in that money you have to try to see that which are all the high yielding schemes, so that that generates more money for you. And there are various schemes, various bank savings or recurring deposit types. So there are various options available. So these are all the ways by which as a beginner you can apportionate your income. Do with this any of these three types. Maybe you can try all the three types also, I would suggest that way. Okay, and so that you can take appropriate or balanced risk vis-a-vis with respect to your expected earnings, out of this investments, and managing your debt. Okay, when you are buying something, you may have to buy something on loan. So what are the ways by which you can get it on loan, and how to pay back the loan? So anything which is going to which you are going to buy on loan, you need to service the loan, right? You need to pay the interest, you need to pay the principal and all that. And that money, anyway we are going to map it to a part of the income. So if you are going to utilize the object which you are purchasing through the loans, if that is going to increase the value of your original income, that's what we discussed, that has to loop back to your original value, then nothing like that. But on the other hand, if you are going to buy it just for an expenses, then you must be extraordinarily rich to manage that. Otherwise, with the current lifestyle behaviors, even if you go for a film, it costs quite a lot of money. Okay, so everything, there is a lot of money. So if you are going to spend just for the sake of spending, then you must be really cash rich. And obviously when you are doing that, there is a catch. You can use credit card effectively. Okay, suppose your credit card is on say 15th of every month, you have to pay your billing date, for example, and you have to pay on 1st. So how you manage your credit is very important, because any loan default, anything which you have not paid it in on time, that will have an impact on your credit score. And unless you have a credit score, tomorrow nobody is going to give you any loan. So you need to remember that. So what is the best way? The best way is that you need to plan. See, with the credit card, people think that they can spend at discretion, at their own whims and fancies. But actually, if you are into that, then you are in a trap. On the other hand, if you plan your activities in such a way that all your expenses, you do all your expenses around your billing period. Suppose your billing period is 15th to 14th. Okay, 15th of this month to 14th of the next month. Then buy everything around 15th, 16th, so that you will get 52 days or 50 days, 60 days credit. But on the other hand, if you are buying on 14th, you have to pay within 15 days. But if you are buying on 15th, as in this example, you are going to pay after 45 days. So you manage. So credit card is a potential tool for best planner. Okay, but on the other hand, if you are a poor planner, then is all the problem. Okay, so you need to be very clear, and definitely how you pay back. Credit card is again a kind of loan, right? So how will you pay back that money? Everything gets reflected in your credit score, and you have to keep watching that credit score so that you are credit worthy from the point of view of the lender. Okay, so you need to ensure that you don't default on all those things. So with this kind of insight, I mean this is something like a 101 on this topic. I'll try to come up with more details maybe down the line if it is required, and you can give your comments there and how you are able to save in case if you want to. And If you think that you need to adjust your savings instead of 40%, maybe you start with 20% or 30%, and you adjust, track your expenses, and wherever possible your savings be automated. Like you set aside, okay, that 40% or whatever is your percentage for savings, try to automate, like putting it in an RD, recurring deposit, so that automatically it goes to that amount instantaneously. So these are all the things, and obviously you need to avoid lifestyle related problems. Okay, so you should not get into any liabilities where you can't pay. Then you are getting into big risk, and you are setting yourself into trouble. So the common mistakes are, again I repeat, neglecting savings is a common mistake, overspending is a common mistake, purely relying on credit but not wisely planned, this is also a common mistake. Hope you understand this from whatever we discussed on the financial literacy. This is just a 101. Hope you enjoyed this video, and this is Gokul. See you in the next video. Cheers.